Hello, and welcome to our first webinar of 2025. My name is Doug Johnson. I am the Senior Investment Strategist here at HCM Wealth Advisors and CPAs. And today I am joined by Dan Rinck, who is our Senior Research Analyst and also a member of our investment committee. And the third person on our webinar today will be Casey Boland. He is having some technical issues with his computer right now. So when he is up and running, he is going to join us. We're going to have to pivot slightly here, as Casey was the leadoff man here. So I'm going to jump ahead a few slides and let Dan actually start here. So we've got kind of three topics that we're looking at today. The first will be kind of a current update on where the market is right now. Then we will have a brief 2024 in review, and then finally we will wrap things up with our 2025 outlook. And note that I said outlook there, not 2025 market predictions for the end of the year, because we will not give those. But at any rate, Dan, why don't you go ahead and get us kicked off here? Let me go ahead and get moved forward, and off we go.
All right, yeah. So this talks a little bit about 2024 as well to get started out. So the current market environment right now is.
Hey guys, can you hear me okay?
Oh, there he is. we were going to skip over you and do current market environment for the 2024 recap, but if you're ready to go, we can.
Since you're ready to go and
you've
made it, we'll go ahead and go back to the beginning and let you start.
Okay, guys, sorry, I was having some technical issues for about 15 minutes, so my apologies. So, I feel like I'm 57, but my magic number, I'm going to talk about it first of all, is 57, and I'm not talking about my age, nor am I talking about the temperature outside, because I actually have long johns on, just so you know. I'm talking about the number of new all-time highs that were recorded in 2024 for the S&P 500, and 57, it falls into the top 5 years for most all-time highs recorded by the S&P 500 index. So let's dive into the numbers. As we look into the numbers, the S&P 500 was up 25% last year. The Russell 2000, which is small cap stocks, that was up a little bit over 11%, and foreign stocks were up, just 8%. Foreign has really struggled down. It's been a number of years, and bonds were up 1.3%. So first, before we move on to bonds in a little bit more detail, certainly large caps had another big year, continued to lead. The growth sector, as Doug and Dan are going to talk about in a little bit, really led the market over value stocks, and the S&P had a banner year. Small caps, we still think, are positioned to do well in the future, but we do need to still see some trends and some pieces come into play for small caps to continue to participate. But foreign has continued to be a disappointment. We'll have to see. There's some thought that the dollar may have some weakness in the course of the coming years, and that certainly could aid to foreign. But let's focus a little bit more on bonds. So from a bond standpoint, that return you saw of just under 2%, it's a little misleading in that as we look at this particular slide, interest rates actually are still very high for market rates, and you can achieve a very attractive return. So I'm going to focus on the far left column, which are going to be U.S. Treasuries, and then the third column from the left, which is at the bottom says IG Corps, which is investment grade corporate bonds. And bonds have been in a return, if we look at treasuries, from anywhere in the last decade of under 0.5% to over 5%. But you can see currently they're right around 4.5, 4.6%. That's an attractive rate of return. So for many of our portfolios, if you look at your components, you see a fixed maturity date from 2029, 2031, 2028, etc. And we've purchased bonds in the last few years to take advantage of these high rates as we had inflation and interest rates surged. And we've been able to lock in bond returns. If we hold them to maturity, we know what we're expected to receive. So for treasuries, it's in the high fours. And then with corporate bonds, it's in the just above 5% area that we're expecting those returns. So very, very attractive. So I think when you look at interest rates, they can be a little deceptive on returns with bonds because we had a surge in interest rates for a period of time, and bonds look like a teeter-totter on the playground. When interest rates move up, it hurts the value of bonds. And so you can have a little bit of a misleading look for bond returns. But certainly on the face of it, they didn't look attractive. But mind you, rates are very attractive for bonds right now, better than they've been if we rewind just a couple years ago. So moving on, let's look at if you look at what happened on the forecast for returns for 2024, the forecasts were anywhere, we're looking at the far right-hand side of this chart, anywhere from a negative return to 6 to 7% return. And that's a substantial gap between the forecast of 7% on the high side, 6 to 7, to what we actually experience at 25%. So first, I think this reinforces why does it make sense to pay attention to stock market forecasts for the year. They've been off now for several years, but I get it. We tend to reflect as humans the calendar year as it turns. It's just human nature to reflect and get a perspective of what's happened. But how did analysts miss this mark so badly in predicting the return for the stock market last year? Well, let's go to the next slide. I think that will maybe give us and glean a little bit more into this. So a lot of data, a lot of lines on this slide. This slide summarizes what recently surveyed market participants consider the biggest risk to the market stability for 2025. And as you can see, the answer is also for 2024. So I'm going to focus on 2024 for now. And these are associated with the navy blue line. So you look in the key and it says December 23. That's the survey when it was completed as they were looking at the upcoming year for 2024. So if we look at it, the number one concern coming into 2024 was a U.S. hard landing, meaning that people were concerned about a sharp and sudden economic slowdown in economic activity, and many were concerned about the risk of a recession. So if that's a concern, then your outlook for the stock market returns would likely be low. Now, what were some of the other concerns we look into 2024? Central banks hike unexpectedly. Is inflation sticky? Then you see a couple of them in a group together. Liquidity crisis in private capital, HY, which stands for high yield bonds, default rise, commercial real estate slump. All three of these certainly would have been problems if you were having issues in the financial system, which you oftentimes do when you have a recession. And then let's briefly touch on inflation, economic growth, and we're also going to talk about stock valuations. So we're going to shift now to this slide. And given the stock market surge that we had in this last year, stocks did very, very well. So it would be natural to ask, are stock valuations overvalued at this point? And one of the metrics when you look and evaluate stocks is the PE ratio, which takes a look at the price of a stock relative to earnings. And the stock market surged in recent years, which you can see here on the left side of the chart. It would be natural to think that stocks may be overvalued, but stocks actually are cheaper now on a forward basis versus where they were in September of 2020. Well, how can that be? Well, not only a prices surge, but earnings have increased substantially as well. And one important note, and it's important especially with this slide, a forward PE, price to earnings, at expected earnings is really when you're looking at what the expected earnings are going to be for the future. And it's critical that expected earnings growth comes through. And Doug's going to touch on this a little bit more on the outlook for earnings in a little bit. So the picture for stocks is they're not overvalued, but I wouldn't describe them as cheap by any means. Maybe they're close to being more fairly or fully valued at this point. All right, so we're going to shift now a little bit to some of the other concerns that were on the minds in 2024. And again, that was inflation was one of them. So if we look at CPI, which is the Consumer Price Index, if we think about what was going on in 2024, the thought was, is the worst behind us? Inflation surged after the pandemic and peaked in the summer of 2022. And it took 18 months until the end of 23 for inflation to come down close to the Fed's target level. And Fed Chair Powell made it clear he wanted to see inflation rates stay at that level for more than a few months before declaring victory. Inflation increased a bit during the spring of 2024, but then came back down as the year progressed. Now, while the hope was that inflation would be a bit lower, it finally gave the Fed comfort into finally cutting rates in the fall of 2024. And Doug's going to pick up on inflation a little bit in our discussion as we look into 2025. All right, looking into the economy. So let's move to the next slide, the GDP. When you're looking at economic growth, GDP is just the measurement of economic growth output. And coming into 2024, the economy had shifted from very hot to pretty good over the last 2 years. In the context of inflation, that's been a positive development as easing demand allowed prices to cool, but many were concerned that demand may slow too much, which could have been a risk to the economy. And while GDP slowed, it certainly surprisingly kicked back up in the spring, and that was a contributor to the Fed. It shifted on its scheduled, the forecast it had for rate cuts. And most investors were expecting that the Fed rate cut cycle would have started in the spring of 2024, but it shifted. And I think for some people, that was frustrating that the Fed kept changing what they were doing with their policy with rates. And, whether they pivot and begin to cut or hold or whatever, I don't really think that's the right question. The question should be, if they don't cut, then why are they not cutting as they suggested in their dot plots, right? Is it possible that the economy heats up more than initially modeled? And maybe that's a good reason not to cut because they're concerned about inflation going to be bubbling up again. And from an investor perspective, from an economic perspective, that's not exactly the worst thing in the world that the economy wasn't falling apart. Because remember, a lot of these assumptions when it came to the Fed, their pivot, in addition to inflation cooling, it's also tied to the idea that the economy was at the risk of cooling, that growth was slowing and decelerating, and that a lot of people had recessions on their mind. So the good news is with GDP, things came in and really stabilized through the course of the end of the year. It's expected that Q4 will likely be around 2.7 on GDP growth, which is still reasonably supporting stock prices. All right, as we shift and we continue with GDP a little bit, this just has to do with, I've been talking a little bit more about 2024, but now I'm thinking about 2025 and 2026. It's good to see that as it relates to the economy in the future, that you see high level optimism as very few countries around the globe are expected to be in recession in 2025 and 2026. All right, so shifting, going back to that slide that we saw earlier, and it had to do with the risks. The risks now for 2025, and this is something that Doug's going to focus on some of these. So you can see now when you look at 2025, and again, the list is long: global trade war, tech valuations, maybe AI enthusiasm waning, central bank hikes because inflation may be sticky, and bond yields rise more than expected. And again, Dan and Doug are going to touch on some of these items. I mean, it's a long list of worries, and there usually is. There's always something to worry about. That's why you hear that saying sometimes, the market climbs a wall of worry. To some degree, if we're worried about it, then it's already priced in. Fortunately for 2024, the worries turned out not to be as big of an issue as had been once thought, and that turned into a great surprise for the stock market, which meant that we had above average returns, much more than what we were expecting. Now, what's not on the list, that's really what can spark the most volatility, and no one knows what that may be and what could surface in the course of the year. But this is what investing is all about. There will always be something to worry about, and many of the risks that are identified, they don't disappear. They just get reordered and move up or down the list. And, sometimes we worry a little too much about things, and sometimes we don't worry enough. But one thing that's consistent in history, though, is that there's never been an event that the stock market didn't eventually overcome. We'll just have to see how these things play out this year. So, all right, Dan, shifting it to you. And looks like from a tech standpoint, you guys are in good shape.
So, I mean, I was looking at that list and it was kind of small, so I didn't know if, mega cap stocks being a large percent of the S&P 500 was on that list. But for the last year, 2024, even some of 2023, and even now, the Mag 7, the top growth stocks in the S&P 500 are getting even more and more concentrated. So as you can see on this chart here, you have the S&P 500 price chart on the top in the blue, and then the bottom you have the top 10 stocks as a percentage of the S&P 500 market cap. So as you can see, we're on the far right. We're at the highest concentration in the S&P 500 that this chart goes back to. I don't think it's ever even got anywhere close to this outside of these other two instances, the Nifty 50 and the dot-com bubble. So one of the risks, one of the things that we're looking at is definitely the concentration of all these Mag 7 stocks. They have been boosted and bolstered by very strong earnings, the ability to seemingly print money, but it's getting to a point where you're starting to see people say this time it's different, and whenever they do that, it's a little worrisome. But that's one of the things that is on that list that we could be concerned about. But as of now, these companies keep continuing to put in solid earnings. So we're going to keep an eye on it. We need a broadening out in the market, but so far they're really holding up the market. So over the last 3 months, that's pretty much what I'm going to cover is what's happening right now. What are the main themes and trends of the market right now? We have actually gone over this chart on a webinar in the past, and I actually put a little arrow on there. That is when I first introduced this chart back in August 2024. We had a 10% pullback. NVIDIA was really kind of dragging down the market, and there was a lot of concerns around this being the top of the market. Now, we held an overweight position at that point, and we were still very bullish on equities there. And this chart was one of the main reasons. So we saw a 10% pullback, but the bottom chart shows green being percentage of S&P 500 stocks, both above their 200-day and 50-day moving average, which those are historically very strong support levels. When there is an orange bar, that means that is the percentage of stocks above their 200-day moving average, which is a longer term moving average, but below their 50-day moving average. And then in red, you see the percentage of stocks both below their 200-day average and below their 50-day average. So below kind of the medium-term support and long-term support. Back in August 2024, we really didn't see much damage being done in the market underneath the surface. And that's why we were very confident in holding our position that, this was a very isolated event and just a run-of-the-mill pullback. Over the last 2 or 3 months, we've seen a little bit more deterioration than we did back in August. So you're seeing 46% of the S&P 500 are below both their 200-day average and 50-day moving average. Now, the last few days have repaired that pretty significantly, but you're still seeing that the trend, while strong, is starting to begin to weaken. So just something that we're keeping an eye on. We peak to trough, we're only down 5% from all-time highs in the S&P 500. I think we're down 2.5% now, but the trend is starting to slow a little bit. So and it's normal, right? So this is year 3 of our bull market, and year 3 in bull markets is typically a little bit choppier. A lot more challenging. So bull markets on average about 5 years long. We're only in year 3 now, and this chart basically shows that it's not uncommon for there to be a little bit of chop in year 3. So on year 1 in the blue there, you can see the average year is that darker blue line above, and then the time in which we just experienced, October 22 to 2023. We were trending in the same direction. Year 2 in the green in the middle, you have the average year, kind of that lower bar, and our performance, the S&P 500 performance in the year 2 of this bull market was actually significantly above the year 2 average. And then year 3 of the bull market, which actually started in October 2024, it's a pretty choppy trading flat year on average, and we've essentially followed that trend so far. Now, again, this is just an average. That doesn't mean that we're going to be flat the entire year. It's a composite, so we could be in a much better environment than the average, but it's just something that a choppier year 3 is not out of the ordinary. And then to me, I wanted to focus in on what is the main market driver right now. Doug's going to go into a lot of things that we're talking about for 2025, risks, opportunities, everything. But for me, the last 3 months, the main market driver has been inflation and yields. So on this chart here, you have the S&P 500 in black. You have MGK, which is the mega cap growth ETF, and then IWM, that's in red, and then IWM in blue. So I've put some vertical lines on there to denote some significant events that have happened. The first one on the far left, that is the election. So Trump gets elected, you're seeing large spikes across very cyclical parts of the market, namely IWM, which is the small cap ETF. You saw a very significant jump, Trump being pro-business, being able to deregulate, keep taxes low. It spurred a lot of optimism in the market, especially some of the unloved areas like small caps that could benefit from a more business-friendly environment. And then kind of halfway through in the middle of the chart, the main concern that came out was inflation. So when earlier in 2024, the projected interest rate cuts for 2025 were 10. We expected 10, 25 basis interest rate cuts. Now, as you have Trump getting elected, pro-business, lower taxes, people are worried about inflation spiking up, or inflation being stickier or slowly or not really falling anymore. So you saw some events in which we had a hotter than expected CPI report and the market would dip. You had, PPI, market would dip. So in the second bar that I've highlighted there towards the middle right, that's when that was a Fed day. So that was when Jerome Powell essentially came out and confirmed what the market was pricing in, that they were a little bit worried about inflation. So they were going to cut less in 2025, and it really kind of spooked the market. You had 10-year yields ripping to the upside, inflation expectations, everyone was worried about inflation, so that was driving the market down. And then the second to last bar, that was a jobs report. That was just last week. So jobs report came in screaming hot, way above expectations. So everyone was worried, hey, we're going to have a re-sparking of inflation because, we have jobs, we have everything boosting up, and it's causing a lot of anxiety in the market because rates are rising. Fed's not going to cut as much. They were talking about even potentially the Fed holding for all of 2025 or even raising rates. And then kind of to the far end of the chart, you have, this week we had a PPI report that came in kind of soft, and then the CPI report that came in soft. And you saw the market react very well to those reports, basically saying maybe inflation is under control. You have the 10-year dropping. And I mean, really, this has been what the market's been like. It is all inflation and rates driven, and nowhere does it tell the story better than small caps on the next slide. So on this chart, we have IWM, which is in black or dark blue. That's the small cap index. And then in red, you actually have the 10-year yield, inverted. So if the red's going up, that means the 10-year is going down, and basically it's flipped upside down. And you're seeing that IWM is tracking the 10-year yield to a T. As the 10-year yield rises, small caps fall. As the 10-year falls, small cap rises. And it's all based on inflation expectations and rates. And lately we've had a screaming 10-year because everyone's worried that inflation is a little bit stickier than they first expected. And to talk a little bit about how, you can go on the next slide, the 10-year rising so quickly is a little odd. So this chart shows the change in the 10-year yields through rate cutting episodes 1984 to 2024. And Doug's going to touch on this a little bit more. But basically, the far right shows the first interest rate cut in the cycle and then the 10-year yields reaction to it. And as you can see, 2024, you've seen the 10-year yield kind of take off because a lot of people were worried that the Fed might have acted too quickly, that inflation's a little bit stickier than we expected. So that has definitely been a drag on the small caps. And I think it's all inflation, it's all yields. But yeah, so right now it's definitely a yield focused, inflation focused market. We have earnings season right now, and that could really change the focus if we get some good numbers. But lately, it's all been about yields and inflation. What else do we have to think about there in 2025?
Yeah,
there,
Casey provided a laundry list there of things that we could be concerned about. But I mean, in actuality, hopefully I'm not letting people down here, but I think the themes for next year are very simple. They've all been touched on in this presentation already, but sometimes the market drivers are right in front of you. So let's take a look and see what we believe our big themes are. And again, you probably have heard these things come up in this presentation 3 or 4 times already. So again, I don't want to let anybody down, but these are the things that we're seeing that are important. So number one, inflation, Fed, rates. We'll touch on that in just a second. Earnings. Casey touched on it a little bit at the beginning, but the earnings forecast I think is better than most people expect, and that could be an important driver for stock returns going forward. And then lastly, tariffs, which is a brand new topic that we'll look at a few slides on tariffs and give our thoughts on what that may mean. But first of all, this slide is titled "Trust the Fed." If I had more room there, I'd probably put "Trust the Fed at your own expense," because if you're not new to these webinars, I think you've probably picked up on my disdain for the Fed and their forecasting. Now, part of that is due to the market just hanging on every single word that they utter, and their track record is so spotty. It's amazing to me sometimes we put so much emphasis and faith on what they're saying. And I don't think there's a better example than these two headlines, both from Reuters. The dates highlighted in yellow, the first one from September 18th, 2024. Fed unveils oversized rate cut as it gains greater confidence about inflation. So that was the initial rate cut of 50 basis points or 0.5%. Now you fast forward to November 20th, which is exactly 60 days later. Fed to lower rates in December, but slow pace in 2025 on inflation risks. So they went from greater confidence about inflation to inflation risks in the course of 60 days. Now, granted, some of the data changed, but I think the market participants have a tendency to overreact sometimes to what is coming out of the Fed's mouth. Now, what does the Fed funds rate look like going forward? Because again, that is a big driver of market expectations. So just really in line with the headlines that I just showed, but more on a visual basis, back in September of 2024, the expected Fed funds rate in October of 25, so October of this year, was initially below 3%. So as Dan mentioned, the forecasts were for around 10, 25 basis point cuts, which would have ultimately ended up being about 2.5% from the 5.5 that they were at. So we'll call it 3, 2.5. And I think the market priced itself off of the expectation that was going to happen. So fast forward to this goes to November 24th, but now it's up in the range of 3.8 to 4%, which, Fed funds rate is in the range of 4.25 to 4.50 right now. So you're talking about one more cut, from 10 cuts to one cut. Some strategists talking about no cuts, and some strategists talking about one hike. So a big, big flip in expectations for inflation. Some of that, I guess, could be attributed to the data coming a little bit hot. Dan mentioned the jobs report. You're kind of in this backwards environment where, hey, great, this jobs report's too good. Let's sell off. It's very backwards, but that's the market we're in. And I think that other T word, tariffs, played into a little bit, but we will get to that in just a moment. So you can see, though, that the 10-year has risen from the initial Fed cut, and that is a little bit abnormal. This goes back to 1984. So there are some instances actually before 84 where this happened, specifically 1981, where there was a kind of a double acceleration of inflation, so to speak. You had the first wave in the early 70s, came back down, then you had a reacceleration. But in almost all instances outside of that, green being just flat out normalization, red being recession, and orange being a growth scare in the economy, almost every scenario has rates moving lower, whereas this one has rates moving higher. Some of that has to do with the market expecting higher economic growth, which again, in reality should not be a bad thing. But for the rate complex right now, it's causing yields to move higher. And as yields have moved higher, it's causing some trouble for the market. And it has for the past 3 years. So remember, before 2022, you had a 15-year period where money market rates were zero and bond yields were consistently in the high ones, twos, and low threes. So the initial move from 2022, we all remember that, caused the first real bear market that we'd seen in quite a while. Obviously, COVID was a bear market, but I think that was a very unique circumstance. But we'll call this the first sustained bear market that we've seen in quite some time. And you can see that the red boxes here, rates moving higher, causing stocks to move lower. Now, one thing that I will point out is that there's no box over here yet, but this is a pretty big move in the 10-year yield, and stocks have reacted pretty well for the most part. I think it's when that 10-year treasury is getting over, we'll call it 4.75 and the 4.8 and getting closer to that 5 handle. That's, I think, when the market really started to take notice and say, okay, we may have to price the risks a little bit here, or should I say reprice the risks a little bit. But on the whole, I think that the market has actually done pretty well with this rate spike that we've seen recently. Now, it's not all negative news in terms of Fed rates and inflation. Historically, slow easing cycles, I should say, have been pretty positive for stocks. This chart shows a few different cycle analogs, and the first vertical dotted line here would mark day one or first rate cut. And then the second dotted line here is 12 months after that. So the first rate cut, I believe, was in October, September range. So this would theoretically be September, October of 2025. But you can see that the slow cycle here in navy blue is the quote unquote best performer. And then you've got kind of a offshoot of that still being positive, where the fast cycles usually run into the biggest problems. And why is that? Because in a fast cycle, the Fed is coming in and slashing rates to try to combat a deceleration of growth. So if you think about a recession, that's really the only tool in their toolkit that they have to use. So slow rate cutting cycles are good for equities because that means usually economic growth is pretty good during those times. So we're seeing a period of fairly good economic growth for the time being. So it's allowing them to not have to cut rates aggressively as of now. And I think, ultimately in history, that's been a positive scenario. Dan touched on this before. The average return in a bull market year, the first 2 years are usually very good. Then that third year can be a little bit dicey. So if I had to make any predictions going forward, and as you know, I really don't like doing this, because I think anything, being predicted out 12 months is really just a guess. But I would say that it would not be shocking to see the equity returns this year being a little bit below what they were the previous 2 years. That doesn't mean that stocks can't still make money this year. It's just that it might be a little bit more muted than what we've seen in the past 2 years. Now, as we look at the second bullet point on themes, the expectation for earnings this year is really good. So you can see that the S&P is expected to report growth of 15% for 2025. And then if you want to come all the way down here, 2026 is also 13.6%. Now, these can be revised down pretty much at any point, but it's important to remember that, stocks go up in value based on the earnings growth that they produce. So seeing 2 years of projected double-digit earning growth on the heels of the really strong years that we've seen in the equity market is certainly a sign of optimism for risk going forward. And if we break it down a little bit further, you can see this segregated between large cap, mid cap, and small cap. Because one of the things that we have seen is a concentration of returns in that large cap space, which isn't ultimately surprising because large caps have generated a bulk of the returns, especially over the past 2 years. You have 9% and 14, where small caps now are predicted to grow their earnings at pretty good clips going forward. So as Casey mentioned, it's one of the areas where we think there could be some opportunity. The price has to cooperate, which it just simply hasn't done yet, but we're keeping a very close eye on how the acceleration of earnings in the kind of other 493 stocks in the S&P 500 versus what we might see out of the Mag 7. And then lastly, tariffs, everyone's favorite topic. So this is an economic chart of tariffs. So pretty simple explanation as to how tariff work. No, actually, I'm kidding here. We're not going to go through this chart, but if you wanted to torture yourself, you could look through this and see exactly what economists view as a kind of supply and demand chart for tariffs. I think this is a little bit better explanation for kind of what a tariff is and what we're looking at. So it's basically just a tax charged on goods coming into or out of a country. The goal would be to get people to buy more domestic goods by making them more competitive with foreign goods. So if you go all the way down to the bottom, you can see a very, very simplified example of this. So let's say the US, makes or sells socks at $3. The UK sells their socks or creates them at $3. We slap a $1 tariff on there. Now the UK socks are $4. Oh, look, the US socks are cheaper. We are going to go and buy the US socks. Now, the flip side to this, and I think where people become concerned about the inflationary part of this is, let's say that it's China and they're selling socks at $1. Well, we're going to tariff $2 to make it $3, and now you have equal prices. But what you lose is the ability to substitute what would be the domestic good for a foreign good that may be cheaper. So ultimately, that would push prices up as it supports domestic production. It could also push wages up. But I think the important thing to remember about the tariff situation is that, one, it could be a starting point for simple negotiations. There's one thing that politicians are really good at, both Democrats and Republicans, and that's promising things that they end up never doing. So I think there's a lot of talk right now, some very aggressive measures in terms of tariffs, but I think it's very important to remember none of that has been instituted yet, and we need to wait and see exactly what is done before we jump to any conclusions about how this might affect overall inflation rates or the market. Now, to give you a real life example, because we've actually already gone through this, if you go back to 2017, you probably remember headline after headline after headline of U.S. and China trade talks are going, and insert whatever you want, good, bad, indifferent. But this simple headline was market moving news every day. It would drive you crazy, but that's the reality. And you can see here, this is the S&P 500 from the point of what they call the first escalation. And if you remember, the Chinese tariffs were mainly focused in aluminum and steel. So I think it's also important to see what exactly is the tariffs being put on. But these red diamonds here are considered quote unquote escalation headlines. And then these green ones are considered de-escalation. So the important thing is from first escalation to last escalation, the S&P 500 really did nothing, went sideways. In between that time, there was some volatility and there was some movement there. This period, people might say, oh, well, you had this big market drawdown. It's also important to remember this was the time when the Fed was first trying to hike rates. And it got to a point where the market said, yeah, you've gone too far. They said, okay, the famous Fed pivot on, I believe it was the day after Christmas or right around the first of the year. And then everything turned around fairly quickly. So what I would say is tariffs do have the ability to generate inflation, but I think we need to wait and see exactly what, if anything, is being implemented. And then I think we can draw a better conclusion at that point. But the market is already kind of front running that and have certainly added that to their inflation expectations going forward. So finally, this is more of just a general reminder than anything else. Volatility in the market, it's normal. We've seen the past 5 years of returns. You've had 4 outstanding years, 1 not so outstanding year. But the thing that I would say 4 out of the 5 of these share is that you saw some pretty healthy volatility in between that year. Again, I don't like to use 2020 just because I think there's so many outliers with it. But I mean, look at the past 3 years. 2022 obviously was a down year, 25% drawdown. The last 2 years specifically, 26% up, 10% drawdown in that time period, 25% up year. You had an 8.5% drawdown. So we just experienced a 5% drawdown here over the last few weeks. And since we've had such a good run, it probably felt like it was more than that. But in reality, it was a completely normal part of the market. And we would expect to see more volatility going forward. It's not a call for a bear market or a market crash. It's just a call for normal market activity. So it's important to always take a step back and realize that there's no return in the market without risk. So from a positioning standpoint, where are we now and what are we thinking about? So we remain overweight U.S. equities, but we are acknowledging the fact that the risks are growing. There are things that are starting to percolate in the market that maybe haven't been there in 23 and early parts of 24. So we've had some discussions on when and how we might reduce that overweight at some point. We're not quite there yet, but the discussion has certainly come up. We think diversification remains important during periods of concentrated returns. As Dan mentioned before, the S&P has been the main driver of returns for the past 2 years, and that index has become very, very concentrated. So we want to be aware of that and make sure that we're not, falling into that and going along with that concentration, realizing also that if that's where the returns are coming from, we also need to participate in that. But we do feel like diversification remains an important part of your overall investment allocation. Fixed income remains positioned across several timeframes and sectors. We have recently allocated a majority of the money market funds that we held into some defined maturity bond holdings, which, as Casey mentioned at the beginning of the call, we feel like have locked in some really, really good returns and high levels of income for the foreseeable future. And then lastly, I'll come back to this, but inflation yields earnings are really going to determine the next moves for what's going to happen in cash, stocks, and bonds. So certainly a lot to go over, but we're pretty sure that these are the themes that are going to dictate what we see going forward. So real quick, I had some questions come through here, so let me try to touch on some of these. So first one is kind of a more specific question, asking if we're taking positions or trying to look to be a part of the AI growth trajectory. I know AI has been a big buzzword topic. So yes and no is the answer to this. I think the tricky part about AI is it kind of touches a lot of different industries. And there's no better example than if you were to go and, I'm not going to name any specific companies, but one is a color and a hard substance. So if you were to look at their robotics and AI ETF, and you looked at the top 10 positions in there, I think you would see a lot of familiar names, which to me says, okay, there's really no, single AI story. A lot of these big mega cap tech companies are, becoming the front runners in AI, both from a spending and a use standpoint. So really, I think we own a lot of them already. So I don't know that we're going to add any additional ones. I feel like those stories are embedded in a lot of the names that are already owned throughout the portfolio in some form or fashion. And then the second question is more about energy and really kind of a policy question. If we expect or what we expect the outlook for energy to be if the new administration's policy is to be more aggressive with drilling and increase supply. So, I mean, again, it's hard to denote, any kind of, single sector based on the administration. We had a really good chart in the last webinar that showed the difference in return between what I guess we'd say traditional energy and then clean energy under both the Biden and Trump administrations. And if I would have asked you what you would expect, I'm pretty sure you would have gotten it wrong, because the returns for clean energy under Trump were incredibly high, and the returns for traditional energy under Biden were very high. And you would think, based on the policy positions, that would not be the case. The thing I think about important about energy is the demand's probably not going to drop, but creating new supply in the energy space is not like flipping a switch. Restarting wells, spending money for new projects. It takes some time before we can get that oil out of the ground, so to speak, and really make a dent in creating new supply on the market. So I think energy is still going to be a sector to watch. It's performed very well over the last few weeks, obviously, as inflation's gone up, but most energy companies are pretty good at making money, providing cash flows, providing dividends. So I think energy is still going to be a popular sector going forward, and would be considered a part of any normal allocation. So I don't see any more questions coming through. So Casey, I'll go ahead and let you take us out here.
Sure. Well, thank you, everybody, for attending, and we appreciate the trust and confidence you have placed in HCM Wealth Advisors and CPAs. Please don't hesitate to reach out if you'd like to discuss your individual plan. We are glad to help. And if there's a family member or friend that we can help, please don't hesitate to reach out to provide an introduction. We would be honored. Thank you, and have a great evening.